My name is Dean. In this video, I'm going to talk about how to analyze business transactions. Andrew has established his lawn mowing business and named it Safe and Quick Mower. These transactions were recorded during the month of July, and these are what we are going to analyze. Andrew started his business by depositing $40,000 into his business bank account. Can you identify accounts involved in these transactions? First one is to identify what is coming into the business. And this one here is cash. So we can identify one account is cash account. And what is cash account? Cash account is an asset account. Is it decreasing or increasing? We say in this case, money is coming into the business. So cash account is increasing. And what happens when an asset account increases? You debit. And what about the other accounts that will go to the credit side? That will be capital. Capital is money invested by the owner in the business. Is Andrew capital? That will be on the credit side. On the debit side is cash. You debit cash and you credit Andrew capital. 5th of July, there was another transaction too. And that transaction, can we identify accounts involved in this? Land. Purchase a plot of land from K for $50,000. This K is a company. Safe and Quick Mower bought that piece of land. This land is an asset. So when an asset increases, we debit. So we debit land, and the amount is $50,000. And what will go to the credit side? How did Andrew business purchase this piece of land? $20,000 cash and arrange to pay the balance within 10 days. When an asset account decreases, we credit. This cash account will go to the credit side, and the amount is $20,000. And from the rules of the accounting equations, the debit side and the credit side must always be equal. So what are we going to do? The difference between this and this will give us $30,000. And that $30,000 is the portion of money that will be paid within 10 days. And the account we will have for this is going to be a liability. So we will have an account called account payable for the balance. So we will credit accounts payable, and the amount is $30,000. So $20,000 from the cash account and $30,000 for accounts payable will give us $50,000 on the credit side. And we have $50,000 on the debit side. That means our accounting equation is balanced. So this one is accounts payable. This part is account payable for the balance that will be paid within 10 days. Because we have accounts payable increasing, we credit. Liability accounts, when it is increases, we credit. And that's why we credit accounts payable here. On the 6th of July, there was transactions. Purchase office equipment for $2,500. paid cash. Office equipment, it is an asset. Cash is an asset. Office equipment is increasing. When an asset account increases, we debit. So we debit office equipment and cash. We use cash to pay for this office equipment. That means our cash account is decreasing. We credit cash. So on our debit side, we will have office equipment, 2,500. And on our credit side, we will have cash of 2,500. So let's come to the 8th of July. There was transactions, and that transaction, business borrowed money, $18,000 from the bank for business purpose. Loan is liability. As a liability account is increasing, so we will credit loans, $18,000. $18,000 cash is coming to the business. So we debit cash account, which is an asset account. It is increasing, so we debit cash. $18,000 is the amount. And on the credit side is loan. Loan is liability, and it is increasing. So we credit loan of $18,000. So what do you think about the rules of our accounting equation? Is it balanced or not? If we have $18,000 cash on the debit side and $18,000 of loan on the credit side, 18,000, that's balanced. Let's go to the 10th of July. Business board, office suppliers, business uses to run the office. They're not for sale. These are assets bought on account for $200. On the credit side is accounts payable of $200. We have $200 on our debit side and $200 on our credit side. So that accounting equation is balanced. 15th of July, Safe and Quick Mower performs service to X on account for $5,000. If you see this one, business performs services, or a business sold some goods on account. This account is not accounts payable, but is an account called accounts receivable. Accounts receivable is an asset. We debit accounts receivable. And what about on the credit side, credit service revenue? When revenue account increases, we credit. When it is decreases, we debit. In this case, revenue account is increasing. So we will credit service revenue of $5,000. On the debit side, we have accounts receivable of $5,000. On the credit side, we have service revenue of $5,000 from our accounting equation rule. The debit side and the credit side must always be equal. And in this case, we have 5,000 on the debit side and we have 5,000 on the credit side. That means our accounting equation is balanced. On the 18th of July, there was this transaction. Andrew Business, which is Safe and Quick Mower, paid $2,500 to K. To K here is the business from which Safe and Quick Mower purchased land from. This $2,500 to K for the outstanding amount. What was that? It was this one here, this part. There was outstanding amount here. And that was $30,000. But this one here is $2,500. What we're going to do, liability account, which is accounts payable, is decreasing because 2,500 has been paid. So we are going to debit accounts payable, and the amount is 2,500. And what are we going to credit? What will go to the credit side is cash, because that transaction cash was used to pay accounts payable. So this one here, we are going to credit cash. It is an asset account and it is decreasing. So we are going to credit cash. So accounts payable, 2,500, and cash of 2,500. From that, the accounting equation rules has been met in this case. On the 20th of July, receive 1,000 from X. So this X is the same clients that Safe and Quick Mower provides services to. This is receiving cash from the previous customer, which we recorded on the 15th. Accounts receivable that we recorded on the 15th is now decreasing, and cash account is increasing because we are receiving cash. These are two asset accounts. These two assets accounts are cash and accounts receivable. One is increasing and the other one is decreasing. So cash account is increasing. So we debit cash and the amount is 1,000, and we credit account receivable because it is an asset account, but it is decreasing. So 1,000 on the debit side, 1,000 on the credit side. Our accounting equation is balanced. There's another transaction on the 24th of July. Paid 1,200 wages to workers. Wages expense. It is an expense account. When expense account increases, we debit. When it is decreasing, we credit. So what is happening here? Wages expense is increasing. So we will debit wages expense and we credit cash. And the amount, wages expense, 1,200. And you credit cash of 1,200. Accounting equation is balanced. Andrew, a business here, Andrew withdrew 1,000 cash from the business for personal use. This account, as you see, one is this one, which is cash. It is an asset, but the owner is withdrawing some money from the business, has withdrawn some money from the business for personal use. This one is kept separate from expense account. It is not part of the expenses. When business owner withdraws some money from the business, this one is recorded in separate accounts, and that account is called, drawings. If it is a company, that will be dividends. But this one is a sole trader. This one is drawings. So you debit drawings and you credit cash, drawings of 1,000, and you credit cash, and that will be 1,000. From our expanded accounting rules, which we learned from the previous videos, drawings was one of them. You already know when drawings increases, you debit. When it is decreasing, you credit. So this, you debit drawings and you credit cash, which is an asset, and it is decreasing because the owner has withdrawn some money from the business. 27th of July, there was this transaction, paid office rent for $600. Office rent for $600. Rent expense it is an expense, and we know when an expense account increases, we debit. If it is decreasing, we credit. In this case, rent expense is increasing, so you debit rent expense and you credit cash. You're using cash to pay the rent. 600, counting the question is balanced. Coming to these transactions, which occurred on the 29th of July, Andrew received a phone call from a client. So what are we going to do with this? Accounting has so many concepts. Here cannot be recorded. It is not affecting any account in the accounting equations. Can you identify an asset account here? Can you identify liability accounts? Any equity account? No. And I'll explain some of the concepts to you in different videos. What about this one here? The last one here. This one. Borrowed 10,000 from a local bank to replace his private car. Can we record this transaction? The answer is no. We cannot record this one in business book because there's an accounting concept that explains this. The reason we don't record this is called entity concept. It says the business is separate from the owner or other entities. So this one is not related to the business. Although you have a figure, you cannot record it in business book. So we leave this one here, cannot be recorded. And the reason for this video is for you to know how to analyze business transactions and to identify an account. When you are given different transactions like this, you should be able to know what to do. Found this video helpful? Subscribe and make comments and also share it.